Hello and welcome to a very special edition of the Self-Storage Report. I'm your host, Thaddeus Campbell. My co-host, Chris Berg, is on vacation in Mexico City. Pleased to be joined by three incredibly powerful folks in the capital market space, securing debt for your projects in self-storage. And we're going to dive into with them in a second. I want to give a shout out before I do that to our title sponsor, QuickStore. Chris and I so thankful to have QuickStore jump on board with us. Brett Henry and his team have developed state-of-the-art software management system for self-storage operators looking to grow their platform and compete in the market going forward against the REITs and large private equity groups. Check out QuickStore at quickstore.com. They are the Italian supercar of property software management systems. Excited to dive in now with people I consider to be friends and very lucky to consider friends in the industry. All of you individually have been on my other podcast at times and excited to really kind of dive in. This podcast is a little bit different and we're much more about what's going on in the industry and data and facts. So really excited to dive in with you guys. I want to start off with a question about what's happening as we see the finish of 2025 and what's changed over the course of this year about how the places you're going to get debt. Whether that's banks, it's CMBS, it's life insurance companies, whoever it is you might be getting money from is responding to the self-storage market as we end 2026. I'm going to introduce them before I ask them to answer that question. You see Anna Siradze, she's to my top right on my screen, Talinvest Capital. They've been in the self-storage industry, placing debt and equity in self-storage for 30 plus years. Bottom left on my screen, Andy Bratt of Gantry. He and his partner, Amit Tyagi, well known across the self-storage industry, all sources of debt that they work with, but especially known for their work with life insurance. And then on my bottom right, Cody Baker, out of the DFW Metroplex, Baker Capital, does a lot of consulting for folks himself. Also has an incredible newsletter called The Storage Vault. If you're not signed up for, highly recommend. I get a ton of information from Cody with his newsletter. So I'm going to go back to the question I asked as we head to the end of 2025, going into 2026. What's changed for people sourcing debt into the self-storage industry as we finish out this year? I'm going to start with Anna Siradze-Herdina from Talinvest.
Thank you. Excited to be here. Thanks for having me. In terms of what's changed, I don't think a lot from 2025 to 2026 has changed. There's an abundance of capital still chasing the sector. The directive to continue to deploy that capital towards self-storage, I think, continues to increase. And we're seeing a lot of activity across life companies, debt funds, banks, CMBS, et cetera. So I think that's going to stay the same, if not maybe increase. The one thing that we're still in a position with is when you're looking at the underwriting and rental rates and occupancy and some of that softening in the market, that continues to be, I think, the question mark of where are we going to head into 2026 and how will lenders look at their underwriting.
Andy, I'm going to throw that same question to you as we're finishing 2025. Are you seeing any, and maybe I'll switch this question a little bit, going back to where we were in 23, 2024, coming into 2025, are we seeing more coming into the market? Are we seeing tighter underwriting on the debt side? What's your take on where we're at in the market today?
Sure. And thanks for having me on, Thad. You're incredible at kicking these off. I always enjoy it.
I appreciate that. I appreciate you joining us. I know you're traveling right now. You're in a hotel room in Arizona, so we appreciate you making the time and setting yourself up to come and join us.
Absolutely. So as Anna mentioned, there's an abundance of capital. If you rewind 15 to 17 years ago, the GFC capital was frozen. That's not the case. There's an abundance of capital. It's just whether or not it matches up with what borrowers want. So the biggest change I think that we're seeing going into next year, a couple things. Banks are coming back, so the banks are becoming more competitive. The other markets are still highly liquid, CMBS, debt funds, and the life insurance companies. Life insurance companies still or will have new allocations for next year, so they're going to be very active, and I'm sure we'll touch on that capital source later. The biggest challenge that we're seeing in the market and the shift is the amount of deals that are still in lease-up that have been slugging along. And that is starting to become more and more challenging. This year and going into next year, we're seeing the need to pay off a lot more of these loans, whether they're maturities, the banks or lenders are not giving any more extensions. That's becoming a challenge. And the more of that product that's hitting the market, it's kind of flooding it. And I think it's going to be more and more challenging to finance these 3 to 6 debt yield deals that have been just riding there for the last 2, 3 years. And then now all of a sudden we're projecting these large rental increases and everything's going to be growing, and NOI in the next 2, 3 years is going to be stabilizing to a 10 debt yield. So got to have the right story, the right property. But that is one of the shifts that I think is going to be very challenging with the amount of payoffs. It's almost easier to have a new construction project with early on in lease up and getting, because you can believe in where it's going to be headed. But deals that have been slugging it around for the last few years are becoming ever more challenging to finance.
Cody Baker, anything to add to that? Cody, I don't know how you got muted there, my friend.
Yeah,
There
they
we go.
hit the nail on the head on both sides of that question. I think the only thing I would add is, I do think that the sector is getting more attention today than it was a few years ago. I just think that from the banking side of things, the life co side of things, that they're just asking more questions than they used to. There's a lot more check boxes to meet. Because through every downturn, these lenders get smarter and then they create policies internally to protect against such situations. We've helped a couple clients this year save those situations where it hasn't been stabilized for the last few years because of various reasons, and we still need a few years to stabilize. So Andy hit the nail on the head on that one. We're actively dealing with that as well. And to Anna's point, the banks are getting more competitive. They're becoming more of a player for the asset class. Debt funds are very active, and all of that coupled into everybody is asking more questions. So it's just being more prepared with your business plan and the story that goes with the business plan, not only from your story as the buyer, but what's the historical story of the property, the seller, the situation, and the business plan going forward, and how do we validate that. I think that a lot of the banks and credit unions and life companies are giving a lot of scrutiny to rental rates and what investors are assuming as rental rates can be achieved. And if the pro forma is pushing rental rates beyond where the market is today, which assumes inflation to meet certain debt hurdles, that's a tough conversation. They're not getting on board with that mostly. So that's what I would add.
A couple questions that have popped into my head just coming out of what you guys said. I think the first one I'm going to ask, and Andy, I'm going to start with you this time, is we've been talking in the industry about a challenging couple of years, and yet it seems like we still have more and more money wanting to come into the industry, whether it's debt or it's equity. What is it about self-storage that even in what we consider in the industry a really challenging time, you alluded to rates, people having a challenging time getting lease up to economic occupancy, and yet we're still seeing, it feels like, more money wanting to come into the asset class?
So historically, we've been one of the best performing asset classes. And I think that historical performance really supports the industry. We know that in times of economic downturn, storage still performs pretty well. When things are great, storage does amazing. So I think that fuels the investment thesis. The other flexibility that we have is the monthly rents, ability to kind of push and pull levers to adjust to market fundamentals. That makes it unique. I think that makes it easier to navigate some of the potential headwinds. And that is exactly what's happened, right? We saw the push for occupancy and what kind of the REITs were positioning for. As a result, in some cases, that asking rate versus in place rate, right? We have a pretty big delta in some cases, and that's hopefully starting to narrow. At least we're seeing some cases where it is. But yeah, I think that's ultimately what the allure is, and with capital chasing it. The other part that's interesting to note is when there are scenarios of, okay, maybe you bought at the height of the market, right? True distress, like what you see in office and people showing up to the table to purchase the site, we're not seeing the pennies on the dollar like you are with some other asset classes. So I think in those cases, there's still, I think, an exit. Maybe it's not going to be as much. Maybe you'll lose a bit, but it's not that you're, now down 75% from what you initially invested.
Andy, Bratt, I'm going to follow up a question there and ask you. It's something we've talked about on this show for months since we first started the show back in June. Chris and I ponder, how are we escaping a bloodbath in this sector with what we've seen from rates? We know people took some really big refinances back in 2020, 21, 22 when rates were super low. With DSCRs being what they are today, are we going to see some assets come up over the next year, 2 years, 3 years that do have to sell at a distressed rate, or are people going to be able to get out of things without feeling too much pain?
It's a great question. I think there will be some pain. There's clearly pain going on in the market right now. I'm sure everyone on this call takes calls from clients looking for capital, right? And they're not leased up. They're 50, 60% occupancy. They have a loan coming due. They have cash needs. So I think the groups that are going to be hit are the ones that don't have patient capital, whether that's an equity source with a closed-end fund that needs to get out, a syndicator that probably didn't, that is having capital stack issues, maturities. There's going to be a lot of forced issues. Now, I was just talking about this yesterday. I don't know if this ends up becoming, like Anna mentioned, the pennies on the dollar, which we're experiencing with office. I think this is going to be, some of the equity gets wiped out, or you built it, you refinanced it 3 years ago. Now you can't refinance, or you can't get out of your construction loan. So I believe it's now forced sale, where that market has roughly dropped around 20, or equity is probably, valuation, have dropped around 20%. So you might be equal to your loan amount. So there will be some equity wipeout, where I think the people that survive on this are the ones that can get extensions, but extensions aren't solutions. They're temporary. It's just buying you time. And again, it's like, they're not solutions, right? So we just, over the last 15 years, if you look, we just went through this on some charts. We've built, I think, 300 million square feet. It's almost double the size of the previous stock in the market. Institutions came into the market, sometime between 2015, 2020, and the amount of building was just enormous. So I do think there's a ton of capital still attracted to the space. I believe that equity, just in general, across all asset classes, is pretty fickle. It's hard right now. And that's why a lot of these groups are having challenges recapitalizing or selling at values that they need in order to get out. So to summarize, not to be doom and gloom, but I believe there will be assets that are troubled, and will show some distress. But, we've said that during COVID, during, other kind of cycles, and a lot of money gets raised to buy the distress and we never see it. But I feel like it won't be in mass. It will be selective. So there will be some, but it's not going to be in droves.
Cody Baker, thoughts on that?
I think he's absolutely right. I don't know that I have a ton to add to that, other than touching on kind of where the asset class is today in comparison to the other asset classes. Pennies on the dollar on the office side. Well, default maturities are at 11%. I think I just talked about this in one of my newsletters last week, where self-storage, just because of how the lenders classify self-storage, it gets lumped into industrial assets, which is at 0.5%. Storage by itself is like 0.1%. But then you look at office at 11%. I think multifamily and retail are right about the same, about 6.5% of maturity defaults. So it's just the resiliency of the asset class, and the guys that are just buying the, putting a Band-Aid on the project now to extend their current loan and hopes to recoup some of that value. I think Andy hit it on the head. I mean, it's about a 20% slice right now that's coming out of equity, just based on the trickle effects after COVID and the inflation and all these other macro events. That I think it's selective. A lot of people are able to write it out. I'm one of them that bought a property in 2022 where the value of the property is probably sitting at about the loan amount, but we still have 2 years left on the loan. We can ride that out. We're fine on our DSCR covenants. So we are one of the few that bought at the tip of the market, got really hurt by the interest rate increases and losing the value of that equity. But it's not putting our portfolio in the dirt. It's just one of those Band-Aids that we need to ride out for a little while and get out of the deal when we can and get on to the next one. It doesn't mean that we're done buying storage just because one deal was bought in the wrong time. So still very optimistic. I think the lending sector is still very optimistic, but again, asking more questions and making sure it's a viable deal to weather whatever storm comes next, right?
We'll dig into that as we come to the conclusion of this in a little while, because I wanted to get all three of you to kind of give an input on how important it is for somebody, no matter what type of a loan they're trying to get, to be prepared for what they're going to need to have in place. I wanted to bring something up Andy sort of alluded to with the development. Obviously, S3 Partners, we're owners, reps, and developers ourselves. So this is something that's near and dear to my heart. And you mentioned, right, 95% of the existing storage in 2015 was then added between 2015 and 2025. So just a tremendous amount of new supply that came on the market. I'm interested to know if on the lending side of it, you guys are seeing a slowdown on that side of it, if it's getting harder to get new construction funding, or if we're still seeing that banks and other lending outlets for new construction are lending deals in that space. I'm going to start with Anna. I'm sorry.
Okay. Sure. Andy doesn't want to go. Good question. So lots of construction. I mean, so construction definitely, compared to where we were in the peak of 2018 in terms of the new supply that was impacting existing self-storage footprints, that for sure, I think a lot of projects were put on the back burner, and what you're seeing, those deals that are just sitting there, right? So no action has been taken. We are such a micro market, right? We're really focused on that 3 mile, maybe 5 mile. So it is very market dependent. But I am seeing some great developments. There's still opportunities that exist out there for sure. In terms of lenders, banks, I think today are still like your best bet from a construction perspective. They have just the most competitive pricing. But then what they'll require or typically want is that the sponsor either is in the market or they have, some kind of historical experience, et cetera, that brings them to the market. They're very relationship driven. With life companies on the construction side, there's typically just and Andy can speak more to this, but a higher dollar amount to get that done. But yeah, we're seeing deals that are penciling, construction sites that I think look attractive, and we're definitely certainly busy with that.
Andy, you want to talk to me a little bit about life insurance and whether or not they're getting involved in that market?
Sure. The short answer is not so much, right? So Anna kind of alluded to it. The life insurance companies, it's a really small pool of lenders that will actually do construction. They're typically wanting larger check sizes, and just how their capital works, banks, they're matching to short-term liabilities being deposits. So construction being more short-term works well. The insurance companies are solving for longer-term liabilities and doing asset matching, and they're regulated differently. And so they have what are called CM ratings. There's CM1, CM2, and CM3. We don't have to get into the weeds there. But essentially, the life insurance companies want to be in a CM1 or CM2 rating as soon as possible, because the CM3 rating, which is where construction would start with no cash flow, becomes very punitive and costly with the amount of reserves that they have to hold. So they're not the best at the construction. They've done a really good job at bridge loans over the last few years, and the perm loans are where they're the best, and that market is very liquid. And kind of to Anna's point, I think the best. I'd agree. Right now, the banks are the best source of capital, but that hasn't been there the last few years. The banks have really kind of resurged this year. If you're going back to late 22, 23, 24, I mean, there was a lot of construction issues, right? You had the banks exit the market, costs were soaring. And if you wanted financing, it was typically an expensive debt fund, and probably double digit at that time, maybe higher, right? To get capital, especially if you wanted non-recourse. So that has shifted, that the debt fund capital has become more cost efficient with non-recourse, but the banks are truly, if you can handle deposits and recourse, because that's still typically a requirement. If you can handle that and a little lower leverage or loan to cost, then those are the best capital sources in the market.
I'm going to move on to we just saw the Fed meet last week. They announced their third straight 25 bip cut. Cody, I'll start with you on this question. Are we seeing that play out in real time? Is it something that the market had already accounted for? Has the market just simply not adjusted to the Fed cutting rates 3 times in a row? Interested to get your take as you're looking at sourcing debt for folks.
I always kind of pause on answering that question specifically directly after a rate cut. What I will say, and reason being, is I like to have deals that I can go and shop and kind of see what the feedback is after that rate cut, to really give an educated insight to what that affected from a micro perspective or a macro perspective. But I think after the last rate cut, the second one that happened this year, everybody came back and they were like, did our rates went down? And it's like, yes, if the bank was based over prime or an SBA loan, government loan, sure. Yeah, you just came down by a quarter point. But when everybody's out there in the marketplace looking for 6.5%, with prime at that point was at 7, not a whole lot of banks were doing prime minus like they were a couple years ago, just to be competitive in the marketplace. So, it's more of a well, it's more of a I kind of lost where I was going with that, to be honest with you.
I've been there many times. Don't worry about it, Cody.
Yeah.
Anna, any take on that and what you're seeing?
Yeah, what's interesting is like today, if we look at SOFR, the 5-year treasury, the 10-year, so the 10-year and the SOFR are basically almost matching, right? So I think 3.73, 3.75. The meeting on the 10th, in my opinion, I thought was a bit hawkish. It's always those two fundamentals, what's happening with jobs, where is inflation headed? I think there was a bit of discourse around there wasn't just as level of agreement as it was last time to for sure cut. So the next one, I think, is end of January, 75% chance. 75% are saying unlikely that we're going to have another 25 basis point reduction. And then March is 50-50. So if you look at Chatham's projections, and nobody has a crystal ball, we really don't know, and those data dependent fundamentals of jobs and inflation, we'll see how that plays out. But I think SOFR is projected by end of 2026 to be as low as 3.14. And then we're seeing the Treasury, both 5 and 10, start to creep up. So TBD, I think there's still a lot of unknowns, and we'll see how January plays out.
Andy, I'm going to ask.
If you don't mind that, I'd like to finish my thought real quick. And it's just what Anna was saying. Anna reminded me where I was going with that. But it was basically that after the last rate cut, which I assume is an aspect of what might happen here, that the treasuries were already priced in. I think at the time of the last rate cut, not this past one, the one before the second rate cut of the year, treasuries were at the 5-year was at 3.6%. And with banks at a conservative 300 over 6.6%, still beating your prime rate. So with my clients, we're looking for the cheapest rates. We target the banks that go over the treasuries, which means that rate cut on prime really didn't have an effect for us.
Andy, anything to add there?
Sure. Yeah, I generally agree with everything. I think the challenge with what the general population and the market hears is the Fed's cutting rates. Oh, my 30-year mortgage is gonna go down. Everything's gonna go down, right? So that's the general population. Everybody on this podcast and probably the audience know that that's not how it happens, right? So I largely believe that the Fed or the actions of the Fed have already been priced in. We saw softer inflation and some jobs reports, right? I feel like, Anna kind of mentioned where we're headed with the longer term. We've had an inverted yield curve for the longest period of history. Typically, a recession follows that, right? So we're now reverted, and there's a natural steepening of the curve. So generally speaking, it's probably higher than 100 basis points, but that's the spread typically between the 10-year treasury and the shorter end of the curve, which we're not there yet. And as Anna alluded to, if SOFR and the Fed funds rate does go down to the low threes, we're already at a low fours, 10-year treasury. That's about 100 basis points. And generally, I think it's actually been wider than that, probably 125 basis points or more. So the market, the Fed controls the short end of the curve with Fed funds rate, and the global market's going to impact how the treasuries are priced, which is generally your longer term fixed type of assets or capital. The shorter end of the curve is going to help your new construction, and it'll provide relief on bridge loans and shorter type of loans. But the Fed, the treasuries are pricing in, to Anna's point, that the Fed was a little hawkish, right? So there's a lot of dissent. You have Powell exiting with a new Fed chair coming in, generally probably pushing Donald Trump's agenda, which is, lowering rates. So what does that do? That probably causes a little bit more inflation. And that's why the longer end of the curve is staying higher in my mind, because they're figuring that inflation, if we lower rates too much, that might spike or have a spur in inflation, which is going to push on the longer end of the curve. So I feel like borrowers have come around over the last few years, that interest rates aren't just going to drop magically. And now we're seeing a big shift for, fixed rate financing. It was always 3 to 5 years, the last few years, and the last probably 6 to 12 months, we've seen a lot of borrowers shift to 7 and 10-year fix because they don't believe the rates are going to be coming down.
That was going to be the next question I asked, and Anna and Cody, I'll open up to you guys. But I've been hearing a lot for the last year. Well, rates are going to come down and everything's going to be okay. Is it time to forget that thesis?
I think, yeah, I don't imagine, from the other thing to talk about that I think is interesting is when you look at credit spreads, right? So if you're looking at perm financing, in some cases, that spread is as low as 120, right, over the corresponding treasury. So how much wiggle room is there really for lenders to continue to tighten their spreads? I don't think there's, the advice I give to clients that are trying to make a decision around their financial strategy. If today the terms that are being offered and your needs are being met, don't wait, 6 months to try to play the market. There are creative ways where, if we're working with a debt fund, you're purchasing a cap. We can do some things where you can purchase a cap at a certain rate. And if the rates continue to go down, then potentially get some money out. So there are those types of discussions of what is the decision that I'm making today based on, do I do a 2+1+1 term? Do I do 3+1 +1+1. And so I think what Andy was mentioning, that decision of what is that structure and how is that structure going to best suit not just your investment, but the cycle of your investment. Are you a long-term holder? What are all of the considerations? There are a lot of considerations that need to be evaluated.
Guys, it's hard to fathom, but it's been a half hour already. I promised all of you I was going to try and keep this thing as concise as I possibly could. I'm going to, hopefully all of you will agree to come back at some point in 2026. I think this is so valuable for the industry and for people to understand, because as much as Andy alluded to everyone on this podcast understanding what's going on, I have conversations daily with people who are still expecting rates to come down noticeably, that are in the self-storage industry and investing actively in self-storage. So cannot thank all of you enough. I'm going to go one at a time. And Anna, I'm going to ask you first. We'll start at the top and work our way around. If there were a couple things you could point out to people if they are trying to source debt as we go into 2026, what are the things they need to have lined up for themselves to make sure that they have the best opportunity to get what it is they're looking for?
I think a really good grasp on your projections. So what do those 5-year projections look like? Where are you getting to within stabilization, and ensuring that you're not using numbers that just cannot be supported, right? So data, and a really strong narrative and strong understanding of your market and what you're working towards.
She's Anna Siradze-Herdina from Talinvest. Cannot thank you enough. You see her email there. You can get a hold of her. Cody, I'm going to ask you the same question. Couple things that you would just say to really be concentrating on if you're looking to source debt in 2026.
The pro forma thing is a big one. I would double down on that, what Anna said, because that is the conversation in every deal that we look at right now. Additionally, I would break down the market stats a little further than we've seen clients do so over the last year to validate where your numbers are and why. The validation, like I said, banks are asking more questions. It's the validation of that and getting them to believe in your business plan. So I think uncovering the market data and making that outrageously forward in your package and very clear cut on how that's being achieved and why it's supported is a big recommendation going into 2026.
Andy Bratt, Gantry, again, thanks for joining us on the road in Arizona. Final thoughts, things to suggest to folks as they're trying to source debt in 2026.
Yeah, I agree with Anna and Cody and triple down. Really kind of figuring out today's achievable rate, what market rate is today, as lenders are looking at the web rates and discounted rates. Really figuring out what today's market rate is. A lot of groups are not doing any trending on that, so figuring that is a lot of what the lenders are going to underwrite to. So again, just going back to what they said, having the right narrative, the story, why it's going to start improving, understanding the supply in the market, and if that's being absorbed, how you're going to start pushing rents. And the fact of the matter is, just get ahead of the financing much earlier on than waiting till last minute. We're seeing people benefit from that. And if you are talking to your lenders direct or one of the few of us on here, get in touch with your advisors, get the advice. Allocations are going to be set from the life insurance company world, early next year. They have a ton of appetite for perm, stabilized and pre-stabilized loans. The other capital sources, they're all going to get flooded with these lease-up deals. So I would say position yourself by getting ahead of that before the market gets flooded.
Guys, cannot thank all of you enough. He's Andy Bratt, Cody Baker, Anna Siradze-Herdina. I'm going to give one last shout out to our sponsors at Quick Store. Cannot thank them enough. I'm going to try and give a shout out. There we go. I got the graphic up. I managed to pull it off myself. Brett Henry and his team, they built amazing property management software. Click of a button to get all the data from your stores. If you're looking to scale in 2026, your storage portfolio, reach out to them at quickstore.com. You'll get a free demo. Mention the self-storage report. You will get a special deal with the good folks at Quick Store. All of you, again, cannot thank you all enough for coming and sharing the amazing information with us. And as I said, I look forward to having you guys back on to do a roundtable in 2026. I'm Thaddeus Campbell. Hopefully my host, Chris Berg, will be back next week. He's on vacation in Mexico City this week. This is the Self-Storage Report. We'll see everyone next week.
Thanks, everyone.
Thank you.